Welcome to MuniLand. This week we're joined by California State Treasurer Bill Lockyer. Good to see you again. Thanks for your time.
Thank you.
California, of course, recently had its credit rating upgraded by S&P. How much is this upgrade going to reduce borrowing costs in California?
Well, we don't know a exact amount yet, but certainly borrowing costs are reduced. We're an issuer of probably several $billion in GO financings this year, and we expect that taxpayers will benefit by an improved rating and lowering costs.
Do you expect that other ratings agencies will follow suit?
Well, we've heard so far from Moody's, and of course they already had us at one rung higher on the ladder, so now S&P and Moody's are the same. We hope to hear in some good way from Fitch, but we haven't yet, and we're waiting to see what their analytics lead them to.
You made reference to the fact that you're a big seller of GO bonds, of course, and you had been set to sell some additional bonds this spring. If you can you update us on the terms or the timing or the amount of bond sales that investors should expect to see from California in a few months?
Well, this spring we expect to be in the market. It's probably $2 or $3 billion. We're still working with the spending agencies in the Department of Finance to determine their specific needs for capital cash this spring, but it's in the neighborhood of probably $7 billion for the whole year, divided into two different rounds, spring and fall.
What are your expectations in terms of demand this spring?
Well, on the investor side, we're finding very helpful movement in the market for us as the demand has improved. The ratings, of course, have helped probably with that, and we've always had fairly substantial retail interest, independent from the large institutional investors.
Do you worry at all about a lessening retail interest given the fact that perhaps some investors have found their way back to stocks?
Well, it seems like there's always lots who want the security and tax-exempt benefits of municipal issues, and so some may be finding money to put into equities, but we're finding a robust bond market still as well.
Now, the reason we're having this whole conversation, of course, is the fact that Governor Jerry Brown presented a balanced budget for the new fiscal year. It is one that included big tax hikes for the wealthy. Do you expect any backlash in terms of residents leaving, or perhaps, in some ways, more importantly, businesses leaving the state?
Well, the actual empirical data shows, for example, new businesses per capita starting in the state of California are significantly higher than national averages and higher than the state of Texas that we sometimes get compared to. Business taxes in aggregate are higher in Texas than they are in California. Now, this is a personal income tax hike that you're talking about, of course, and that's one of the benefits of being in Texas. You get lower services and you don't pay the kind of personal income taxes, though you may pay real estate taxes that are higher than here. So it's hard to identify any significant outflow. There are people we know that grumble about tax rates, but we're not seeing that it's making a big difference. In fact, the sort of ironic study the governor points to of recent vintage is the principal reason for someone wealthy leaving the state is divorce rather than a business relocation.
When you talk about the budget, I'm sure it is much easier now when you have the ability to have a budget with a surplus than talk about when there is a deficit and tough decisions have to be made. But I want to ask you, what's the lesson learned from the last budget cycle? What can California do to keep itself in the black in the next couple of years?
Well, we expect, of course, the economy in the state to continue to grow. Construction is coming back in a healthy way, and that is one of the big factors that contributed to our downturn. So assuming that we continue to have that economic growth, we're, of course, on the Pacific Rim and benefit from a lot of trade and export activity as well as a very diverse economy. Other than that, budget discipline has to be maintained, and the governor is very resolute about no gimmicks and balanced budgets, and so long as that's the discipline, then we're going to see the internal debt continue to be paid down where there's internal borrowing and so on, and deferred payments and things that are still part of our debt picture. But those are getting almost eliminated over the next few years. And then if there's not another huge downturn that affects the revenue side or a spending splurge, it'll be good.
Bill, are you making any contingency plans for any lost federal money that might occur based on what's happening in Washington? And of course, there's a lot of unknowns still on what we're seeing inside the Beltway.
Well, the only contingency planning there is, because there's so many uncertainties about it, is to try to have a substantial enough reserve that you can draw on that if there's some loss of federal support of some sort. So that's the main mechanism we have. And
do you think you would have a significant reserve, should that be the case?
Well, it's, again, we don't know exactly what to expect from federal accounts. There are a lot of states that are significantly more dependent on defense spending than we are. Of course, a big question is health care spending, and while that was not part of the sequestration cuts, when there's future efforts to balance federal budgets, then that may become subject to debate and potential cuts.
California State Treasurer Bill Lockyer, it's good to talk to you again on Reuters. Thanks. It's time now for our Deal of the Week with Thomson Reuters MMD's Dan Berger. Dan, what deal do you have for us this week?
This week I like San Francisco wastewater revenue bonds. It's a competitive deal of $335 million that's AA rated by both agencies that sells competitively on Tuesday morning.
And what are some of the strengths about this deal?
Some of the strengths include that it has access to low-cost water. It serves the San Francisco area, which recently got its GEO bonds upgraded. It has the ability to raise its rates, and debt service coverage has increased in each of the past 3 years.
Dan, what are some of the risks?
Some of the risks include that its strengths is one of its weaknesses, that it's dependent on rate increases. Another risk is that it has a high debt load.
How about the structure of the deal?
It's going to sell competitively on Tuesday morning, and it's going to be offered primarily to California residents and mutual funds who are interested in high-quality California paper.
So there's a retail offering period?
Not per se, but retail investors will probably have preference in terms of getting their orders in.
All right, Dan, thanks very much.
Thank you.
Now, let's look at the week ahead with MMD's Dan Berger. Dan, where are investors going to find yield next week?
Well, it's important to look at the shape of the yield curve. The yield curve has flattened out during the past 6 months, and it's not much changed since the past 6 months, but it's flatter than 1 year ago. When we looked at it, we looked at the 5-year increments. And the 5-year increment that we looked at that intrigued us was the 15 to 20-year range. And we suggested that investors move from 20 years to 15 years. The reason why they should move from 20 years to 15 years is that it's the flattest it's been in the past 12 months, which means that investors are not getting compensated enough to go 20 years, and they're better rewarded for going 15 years.
Any particular sector that looks particularly interesting?
The sector that looks interesting is the healthcare sector. And the reason it looks interesting is we saw research this week that came out from one of the Wall Street firms that talked about healthcare bonds. The spread levels, when you look at A-rated versus AAA rated, are almost at their lowest point for the past 12 months, which means that should they revert back to their mean, investors in these bonds will underperform the market.
Now, we've been hearing for weeks now from smart money managers, time to move back into stocks. We're seeing it in fund flows, a lot of movement back into equities. What does that mean for muni bonds?
What it means for muni bonds are fund flows still remain positive, but what we've seen is that fund flows have slowed down quite a bit. They were very heavy in the beginning of this year, and last week there were about $574 million flowed into funds. This week, about $109 million flowed into funds. So we've seen a dramatic decrease in fund flows to muni bonds.
And how's the calendar look next week?
The calendar should shape up to be about $4.2 billion.
All right, Dan, thanks so much.
Thank you.
I'm Rhonda Schaffler. This is Reuters.